Hey everyone, welcome back to Corporate Decoder. Today, Blue Owl Digital Infrastructure Trust just filed its quarterly report for Q1 2026, and I am seeing some interesting trends in their digital infrastructure investments. Quick note, this is not financial advice, just my take on public filings for educational purposes. This report shows solid growth in their real estate portfolio, but also highlights some increasing debt. Let's dive right into the numbers. As of the 31st of March 2026, this company has a total of $4.1 billion in assets. That is up from about $4 billion at the end of 2025. A big chunk of that, over $3.2 billion, is in their real estate investments. Now, liabilities are also significant. They have about $1.78 billion in secured mortgage loans and notes. On the liability side, total liabilities are just over $2.4 billion. This is down slightly from the end of 2025. Looking at equity, total shareholders' equity is around $1.66 billion, which is up from about $1.56 billion at the end of the previous year. Moving on to the income statement for the first quarter of 2026, the company brought in $90.8 million in rental revenue. However, their expenses were higher, totaling over $104 million. This includes things like property operating costs, management fees, and depreciation. They also had a considerable amount of interest expense, over $24 million, which is a significant cost of doing business when you have a lot of debt. This resulted in a net loss of about $34.6 million for the quarter. This translates to a net loss of 22 cents per S-share for their Class SD and I shares on a basic calculation. For Class A shares, it is a loss of 16 cents per S-share. Beyond the net loss, they also reported other comprehensive loss of about $3.5 million, mainly due to losses on derivative instruments and unrealized losses on certain debt investments. The balance sheet also gives us a look at their share structure. As of the 31st of March 2026, they had over 67 million Class S shares outstanding. This is a notable increase from the end of 2025. Back to the assets, their investments in real estate, after accounting for depreciation, stand at over $3.2 billion. This still represents the core of their business. They also have significant intangible assets related to leases, totaling over $500 million. These likely represent the value of in-place leases and potentially above or below market rates. Their debt is clearly highlighted here, with secured mortgage loans and notes totaling nearly $1.8 billion. In terms of debt investments, they hold about $155 million in CMBs, or commercial mortgage-backed securities. These are essentially bundles of real estate loans. The weighted average coupon is SOFR plus 4%, indicating they are tied to the benchmark interest rate. Looking at the credit ratings for these debt investments, a portion is rated AAA, which is the highest credit quality. However, a significant amount is in lower investment grade categories like BBB- and below, with over 10% in BB- rated securities. The fair value of these debt investments is slightly lower than their cost basis, showing an unrealized loss of about $1.1 million. On the lease front, their future minimum rents from operating leases are substantial, with over $155 million expected for the remainder of 2026. This shows a strong base of contracted revenue from their tenants on their digital infrastructure properties. They declared distributions to shareholders totaling over $23 million for the quarter. The gross distribution was $0.15 per S-share for all classes. However, the net distribution for Class S shares was lower due to the shareholder servicing fee, resulting in $0.1219 per S-share after the fee. Class D also had a fee, while Class I and E shares received the full gross amount as net. Interestingly, the company operates with just one reportable segment focusing on digital infrastructure assets. Their total segment revenues align with the rental revenue we saw earlier at $90.8 million. And the net loss for this segment mirrors the overall net loss for the company at roughly $34.6 million. Looking at their net asset value, or NAV, as of the 31st of March 2026, it stands at $1.86 billion. This is a key figure for investors in non-traded REITs representing the underlying value. The NAV per S-share varied slightly by class, with Class S shares at about 10.1789, Class D at 10.1791, Class I at 10.1792, and Class E shares at a slightly higher 10.2702. This difference is likely due to the varying fees associated with each share class. Their weighted average interest rate on secured fixed-rate ABS loans is 5.39%. This is a fairly standard rate in the current environment, but it is important to remember their variable funding notes are tied to SOFR, which could fluctuate. A significant subsequent event was the establishment of a revolving credit facility on the 1st of April 2026, with an initial principal amount of $200 million. This provides them with additional liquidity. And another important update on May 6, 2026, they increased their gross distribution rate to 50 cents per S-share per year. This shows management's confidence in their ability to generate income. So, what is the story here? Blue Owl Digital Infrastructure Trust is actively growing its real estate portfolio. As seen in the increase in assets and equity, they are generating solid rental revenue. However, the company is carrying a significant amount of debt, which leads to a substantial interest expense and a net loss for the quarter. The increased share issuances suggest they are raising capital effectively, likely to fund further acquisitions or pay down debt. The recent credit facility and distribution increase are positive signs for liquidity and shareholder returns. What I am really watching is how they manage their debt load against their rental income growth, and whether rising interest rates could put more pressure on their interest expenses. The fact that they are a non-accelerated filer and an emerging growth company means they have some flexibility in reporting, which can be good for management but requires extra scrutiny from investors. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded if this analysis was valuable. Hitting that like button really helps. And subscribe for more deep dives. Check out the Discord in the description.